Okay, to finish up chapter 13 here, what we want to think about is what happens in the labor market when we get these fluctuations in output, and then use that to think about, all right, well, when should the government intervene? Because we know that one of the biggest costs of a recession is the increase in unemployment. So just a few terms here that are important. When we talk about the supply side, we're talking about the labor market model because we're talking about how firms are choosing how many workers to employ, what the wages, etc. In the medium run, then wages and prices can change, but things like the capital stock and technology and institutions are fixed. So we're not talking about a long run where firms can increase investment, improve technology, and we can change all the institutions of how the economy is governed. On the demand side is the multiplier model, right? So demand meaning aggregate demand, meaning C plus I plus G plus X minus IM. And what we're interested in then is how the demand side is affecting the supply side. And so that's what we're going to look at now. And then we're going to think about a production function, which basically just means, all right, well, how does employment, capital N, increase output? And the production function in the book is just linear. Basically, it just says as employment goes up, output goes up. Okay, and that's all we're going to worry about right now. We're going to focus on the short run here, but we're going to talk about what might be going on in the medium run as well. All right, so if we're at point A is our normal level of output. So you might hear things like the natural rate of unemployment or potential GDP. The idea is, all right, that's how many workers we employ normally, how much GDP we have normally, and then what happens, right? Well, so in a boom, what goes on is that we increase output, demand goes up, consumers, businesses, government, or other countries are buying more of our stuff, and so more workers get hired. In a recession, C plus I plus G plus X minus IM goes down. They're buying less stuff, and therefore fewer workers are needed to work. So the key here is that we're going to fluctuate around some normal. Now, we know from chapters 1 and 2 that modern economies, that normal is growing, right? It's growing at maybe 2% per year. We're going to ignore that for right now and just assume that our normal is at point A. And so when we get a boom, move myself over here. When we get a boom, what happens? Well, aggregate demand shifts up. We go from A to B. And on A to B, that means that we have more workers. Well, if more workers are working, what's going to happen to the unemployment rate? The unemployment rate is falling. Now, we're still talking about the short run, and so we're assuming that wages are constant, right? So wages are still at that level, but what's going to happen in the medium run when we have a boom? Well, that means there's going to be some pressure on wages, right? And so there's going to be some pressure to increase wages, and that could decrease profits, right? Or it could lead to more firms coming into being. So there's a lot of things that could happen. Generally, what we think happens is that wages go up as the unemployment rate goes down, and vice versa, right? So in a boom, workers tend to benefit. What about in a recession? Well, in a recession, aggregate demand has fallen. So either consumers are spending less, businesses are investing less, maybe the government has cut spending for some reason, and we move from A to point C. At point C, we're producing less. That means we don't need as many workers. That means the unemployment rate has gone down. And again, right now we have the real wage fixed because we're in the short run, but in the medium and long run, that's going to reduce wages, right? And so what we saw is that wages fell or stayed the same during the Great Recession, and really what we're looking for now in our data is for the wages to start really going up because the unemployment rate has been low. We haven't seen that yet, and part of the reason we think we haven't seen that is because the participation rate is still lower than it was at the beginning of the recession. So if we just summarize our chapter here, chapter 13, right? We've got the aggregate demand coming from consumption, right, which depends on target wealth and income. We've got the investment function, which depends on returns from investment, which depend on both the interest rate and the profit rate. We've got government spending, which can change because of automatic stabilizers or because of some other fiscal policy. And we've got net exports, which depend on both exchange rates, which we haven't talked about much yet. We're going to come back to that a little bit more in chapter 16, and foreign demand. Um, Most economists think that automatic stabilizers are one of the more successful pieces of fiscal policy. Fiscal policy, we mean government spending and taxes, and so things like unemployment benefits go exactly to the people who need them, people who are laid off and need to still pay their bills, and that's one of the reasons we think the Great Recession was much less worse, was much uh, wasn't as bad as the Great Depression.